There's a lot of questions out there due to the stock market, inflation, interest rates, and the overall economic instability. With bank collapses, fears of recession, a lot of people just don't know what to do. Before we dive in, now I'd like to ask you to like and subscribe to this channel. You see, we post content every single week that is guaranteed to help you take back control of your money. Also, while you're at it, smash that little notification bell so you don't miss out on the next video series that we're about to launch, and you do not want to miss that one. So one of the questions that's been coming up a lot is, how secure are these mutually owned insurance companies, and how do they fare during a recession? Well, history should be our guide here. If we go back to the Great Depression, then you can see how strong these mutually owned insurance companies are. You see, most mutually owned insurance companies do better during a recession because they have the opportunity to buy more assets at lower prices, just like you would. So when you look at insurance companies, the difference between an insurance company and the strength of them and a bank and the strength of the bank comes down to one thing. Insurance companies have all the money. Banks, they have your money and they only have to keep 10%. Insurance companies keep all of the money that they make promises on. They have to. So when you think about how secure they are, they're far more secure than any bank will ever be, because the insurance companies, they've got the money. So this is a question I liked. It said, what happened if there was a run on the banks again? Would this affect me getting available funds from my policy? So you have to first understand that banks are different than insurance companies, but the two can be tied in the sense that if you got money in your mutually owned insurance company in that specially designed whole life, that money's fully liquid. If you need it, you just go online, click a button, fill a form out, or make a phone call. There's different ways to get the money. But let's just say you click the button and you have that money sent to you. That money is going to be sent to a bank. So my suggestion is, if the bank that you're usually using for that loan to go to, if that bank's in trouble, like Silicon Valley, don't send the money there. Find another bank that's more secured, and there's lots of them. Find a credit union or a community bank. Send the funds to the secure bank, not the one that's in trouble. The insurance company's not going to be the problem. It's going to be the bank. So this one said, I'm 60 years old and I just received an inheritance from my father's passing. Sorry for your loss. Where's a safe place that I can put this money? I'm currently putting it in a CD account. Oh my God. Whew. All right, so there's a lot of safe places you can put your money. One of the last places you should put it is in a CD. You're giving all the control to the bank. Here's what I would look at, and I'm gonna give you a few. Number one, given the economic conditions, this is June 2023, treasury bonds, specifically long-term treasury bonds, would be a great place. Ultra safe, guaranteed by the full faith and credit of the United States government. Plus you're gonna get paid interest on it, probably about the same as you're gonna get in a CD. But what you're gonna do is you're gonna buy the bonds low and eventually sell them high when interest rates go back down. I have a whole nother video on that. The other place is what we've been talking about with specially designed whole life. Nothing is safer than that because it is contractually guaranteed. Now the first thing when I say that the person's probably gonna think is, I'm too old. At 60 years old, you are not too old. Now you might be old for a regular life insurance policy, but remember, these are specially designed whole life policies. So age isn't as much of a factor. In 60, man, you're just getting warmed up. You see, we're gonna design it backwards. We're gonna put the lowest death benefit, the highest cash value. We're gonna design it to be used. That CD, you gotta put the money there, and that money's gotta sit in the bank and wait until it matures. The specially designed whole life, that money goes in, and when an opportunity comes across your desk, you can take action on it. You see, liquidity is very important in these economic times. Oh, this is a question I could relate to. The question says, it's hard to find people to lend money to using my policy. How do I get started? You know, I had the same problem. When I was looking to start being the bank and lending money out, it was hard to find good, qualified borrowers that I felt comfortable lending money to in a first secured position. So what I did is I just created a place where all of those good borrowers are. It's called Private Money Club. So you can just go to privatemoneyclub.com, go on there, create a good profile telling them what you want, and start building relationships. Go in and friend people, start talking to borrowers, start getting familiar with businesses and people that you can lend your money to. This is how I did it. I literally created the community to solve my problem, and now it can solve yours. This person said, I currently have a traditional whole life insurance policy. What do I do if I want to switch over to one of those specially designed policies? I get this question all the time. Now hold on a second. The answer is nothing. If you have a traditional whole life policy, the reason you bought that was probably for death benefits, for protection, maybe a little bit for cash value. So don't switch it over. I never replace whole life policies, even if they're not designed anything close to what we do, because every whole life, let me give you an example. I have my first policy that I started in 2004. It's a standard traditional whole life. But today, every dollar I put into that policy, I take $3.70 out. Did you hear that? A regular traditional whole life, I put $1 in, I take over $3 out? Yeah, because time is your best friend with a whole life. It's compound interest. Whether it's one of the specially designed ones or a traditional one, they all work the same. Do not ever get rid of that policy. Start a new one. So this person asked, how many life insurance policies can I have? How many do you want is what I'd ask. Really, the only restriction for how many you can have is your human life value. Essentially, the insurance company is going to put a value on your life based on your income and your assets, and they're going to project that forward. So the more you make, the more assets you accumulate, the higher your human life value goes, the more policies you can buy. Now, all of us, if we just kept going with the infinite banking concept, we're probably going to max out, but that's okay. By the time you max out, the death benefit you're going to have is going to be significant, and you're going to have one heck of a private banking system. So how many? Pretty much as many as you want. But I got good news for you. When you max out on your life, if you got children, you got a spouse, you got key employees, all of them can be insureds that you are the owner of the policy for. So you can own the policy and they can be the insured. So now all of a sudden the amount you could buy just got expanded. How much money do you need to have to start the infinite banking concept? A lot of people think there's some defined amount you need, and there really isn't. Whatever amount you want to start your policy with. But let me just put a guardrail on there for you. So it all is based on your age. Let's just pick somebody that's 50 years old. It would be 10 times their age for the minimum. So if they're 50, add 10 times to that, that's 500. $500 a month would be their minimum amount that they could do to start the infinite banking concept. That's a number that we came up with because we found that that is what works. So the minimum, 10 times your age, or just add a 0 behind your age, and that's the minimum monthly. So this is an interesting question. The person is asking, how much money do I need to put away per year so that in 50 years from now, they would have $1 million? So this is just reverse engineering. So what I did is I did some math on this. The answer, which is a very simple answer, is about $2,400 a year. So if you had a 50-year time horizon, all you'd need to put away is $2,400 a year to have $1 million after 50 years. But you see, it'd actually probably be less. Because if you use the infinite banking concept, remember, it's not just what you're depositing into the policy, it's actually what you actually use the money for second. So you put the money in the policy, that would be $2,400. But if we take that money out, like we teach, and you use that money to make a second time, it would be significantly less. So the real answer to that question is, it depends on how your money is going to work for you. There's always somebody asking this question.
How much commission did you make for selling those specially designed whole lives?
Sorry, I asked it kind of snarky, but you know there's a hidden message in this. This person is one of them people that probably heard Dave Ramsey say whole life only benefits the agent with that big old fat commission. And Dave Ramsey's right, and just to clarify this question, if I was to do a regular whole life and sell it like I used to as an advisor, well, I would make a big commission, about 55% of the premium you put in. But the way we design them, I'm gonna take about an 80 to 90% cut in my commission so that you have 80 to 90% more money. So how much commission do I make? Well, I make 60 to 90% less than your agent or your broke-ass brother-in-law made when they sold that life insurance policy to you. The one that wasn't built for the infinite banking concept? That's right. If they make money, you don't. So we make less, so you can make more. I'd love to get started with my policy. Where do I begin? Well, I think the beginning place is always where I began, watching a 90-minute video. Now, if you can't see me speak live, then that would be the option. You'd go to Chris Naugle, Naugle.com, and there's gonna be a video that pops up. It's 90 minutes. And you're gonna watch that video, then you're gonna book a call with my team, and we're gonna ask what it is you want to do? What problem are we solving for you? You see, back when I first heard about this, I was an advisor. I thought I knew what I didn't know. And I heard about it from a very wealthy real estate investor. And when he told me what it was, I was in disbelief. Then I wanted to get started because I said, hey, there's gotta be some truth to this. And he said, you gotta watch a 90-minute video and then we can do a call. That 90-minute video changed my life, just like the 90-minute video you're about to watch will change your life. So go to chrisnaugle.com and watch the video, then let's talk. And another thing, if you liked this video, and one of the questions actually alluded to this, then you're gonna love this video right here. It's called the Money Multiplier Method.